Hello everyone, I'm Mark Sain and welcome to Sain Investment Solutions. Please take a moment to pause this video and review the following disclaimer. Thank you for that. Welcome to week 8 of the Forex market review. Today we're going to take a look at the daily FX to see what news has occurred early this week and what's going to occur for the remaining part of the week. We're also going to take a look at the USD chart against another pair, and we'll also have a look at the German 30 and as well as the oil. We had a big announcement overnight which would be affecting the oil, and we just want to see which way it might trade over the next coming weeks. Here we have the daily FX calendar. So what we're going to do is just go ahead and filter on the high importance news, and then once we've done that, we're going to click on and we're going to drop down to your local GMT time. I'm using GMT plus 11 for the east coast of Australia. What we're going to do is change it to the weekly view, and that way we can see what news has occurred at the beginning of the week and what's going to occur throughout the week. It's always good to get used to looking at the daily FX calendar over the weekend or first thing Monday, just to see what news may affect the market. Monday is generally a quiet session day, so if you get the chance to look at that on a Monday, then you can plan your week accordingly. As you can see, Monday, February the 22nd, GMT plus 11, we had no news events, with the first high importance news coming out on Tuesday the 23rd at 9 p.m. Eastern States time for Australia. Now what we had is the Bank of England, Carney, had a bit of a speak, and you would have seen the markets affected depending on which way you're likely to trade that market. The following day, which is today, Wednesday, the February 24th, we had the US consumer confidence numbers. And what we did see is that the actual number came in at 92.2, which was way lower than expected, 97.3. So having a lower number than that definitely would have seen some weakness in the US dollar. So if you're trading the US dollar against any other pairs such as the Aussie USD or the Euro USD or even the USD Canadian, you would have seen the US dollar weaken as the other currency strengthening on these consumer confidence numbers that came out. Throughout the rest of the week, Thursday, February the 25th, we have some GDP numbers coming out for the pound. We're currently forecasting 1.9%, with the previous month being 1.9%. So hopefully we'll see a number around 1.9% or higher. And if we do, we're going to see some strength in the pound coming back in. At this stage, we've seen a lot of weakness in the pound over the last few weeks. And that's just still waiting to see if they're going to remain in the ECU, and that announcement is not likely, or the voting is not likely to occur for some time now. So we really want to wait to see what happens with that announcement. But my understanding is everything will remain unchanged, and they'll continue and sign on as we move forward. And based on that, we should see some strength come back into the pound. So at the moment, the pound is really setting up for some strong buying opportunities. So if you see anything which meets your targets and you're fundamentally still long the pound, then we definitely want to be looking at getting into that trade as soon as we get an opportunity. We've got to remember, fundamentally, personally myself, I believe that the pound is still strong. There is nothing out there which is indicating that the market is now becoming weaker. They've still got low unemployment numbers, good growth and everything. So this GDP number, if we can see it at 1.9 or higher, that's just going to be another positive for the pound. And then I'm definitely going to be looking for some buying opportunities as the market has seen some weakness across other pairs. And later through the rest of the week, we've got USD durable good numbers coming out, as well as the yen consumer price index numbers. So they're predicting a lower number of 0.2 dropping down to 0. So let's see what those numbers coming out. The yen has had a bit of weakness the last week, and generally when the markets get stronger, and that's the indices market such as the share markets, you're going to see the weakness in the yen. So when the share markets start to fall again, then the yen's going to find some strength, and that's something we definitely want to look out for. And for the early parts of Saturday, for GMT plus 11. We've got the Euro-German CPI numbers coming out and the USD GDP numbers coming out. So these are some numbers we definitely want to look out for. And if you want to see weakness in the euro, you want to see some weaker numbers. They are already predicting 0.5 down to 0.2. That would have been factored into the market at the moment. So you want to see some even weaker numbers to see some more decline in the euro. And however, if the numbers are within line or slightly better, you're going to see a bounce back up on those euros. So if you're on a euro short trade such as the euro yen or the euro USD, you probably find it could have a bit of a reversal if the numbers are a bit more positive. GDP numbers for the USD, we're hopefully going to see some good numbers come out and bring some strength back into your US economy. Now let's take a look at some of the charts. Here we have the USD Canadian on the daily chart. I tweeted this on the Twitter feed probably about a few days ago, just advising we could have a double bottom with a possible breakout to the upside. So what we want to do is just go on our charts, and what you can see this time around is I've actually dropped in that Dsr indicator, and that's the indicator. You can go to the website at www.saneinvestmentsolutions.com and go and purchase the Dsr indicator, and that will allow you these horizontal support and resistance areas to be showing up on your charts. And this just gives you an idea at a quick glance of where these support and resistance levels roughly are. So here we can see we've got a support area. We've come down in the market, found a bit of support, bounced around. And so what we want to see for this double bottom is we really want to see a breakout higher. And if we look left, we can see a resistance area. And so if I draw my line in here, we have the resistance area around here. So we want to see a breakout of that resistance. And that also matches up parallel with this one here. So when we see a breakout of that and then a retest, that's where we want to be looking to get into the market. So we want to see a nice move out of the market. Then we want to see that pullback, retest the area, and then look for another move further back higher. And we do take that trade, we'll be looking at this resistance area up here. So if you want to get into the market, always look for your resistance areas. That way you can see that daily candle went all the way up, pulled all the way back and closed in this area. So it's likely we're going to have a stopping area roughly around that price of 14600. So at 1.46, definitely want to be looking at getting out of the market. If we were to look zoom out a little bit more and take our Fibonacci expansion tool, what we do is go from the recent lows down here up to the recent highs and then all the way back down to the current recent lows. And what we can see here is that our Fibonacci expansion level of 61.8 roughly falls in line with this resistance area. So that will just give us another opportunity to get out a little bit early. And if we can take a trade of risking about 300 to make about 600, we've got a good risk to reward, risking one to make double on our trade. Let's jump across now to the German 30 and we'll just have a look at how this is progressing. So what we can see here, it looks like we have a wave pattern cycle on the way down. We got possibly wave 1 for pullback for wave 2 and then falling for a wave 3. Now we can see that this is a wave 3 lower because it's the first largest AO which has occurred in this down channel. So what we want to then do is take our Fibonacci retracement tool, draw it from the highs to the lows of that wave 3 cycle, and what that's going to do is determine where we think the pullback may occur. Now wave 4 pullback generally will occur round about 38.2 to 50%. So at this moment we can see it's reached 38.2 and we're starting to see it fall off. Now this move down lower here definitely would have been a result of the announcement on the oil, and when we look at the oil chart we'll go through that. So we're seeing a lot more weakness in the German 30 or the stock market in Germany, and therefore you'll probably see the safe haven currencies such as the yen starting to strengthen as we see weakness. We definitely have weakness across the board in the Aussie 200 sector as well as the US 30 sector, and they were the first ones to really see the market drive, ending the day on its lows, as the announcement came out overnight for Australia. So if we're believing this is a pullback for wave 4, I personally would like to see an ABC move higher. So we could be up for an A, down for a B, back for a C. I would be looking myself somewhere around these levels of getting in and putting stop losses probably about 4 to 5,000 pips higher, ready for a move down to the lows again of about 10,000. So risking 5 for 10, that's a 1 to 2 risk to reward, and that's definitely a safer bet than trying to take a stab in the dark around these levels here. What we did have, however, is divergence, and divergence does mean that we possibly have a move lower. So here we have that higher high in price with the lower AO, and so that's why we're definitely having a move lower. But how much lower, that's the question. If everybody goes off what was announced overnight with oil, then we probably will see these highs will be the highs, and we're going to see a big downwards move. Let's jump across now to the oil, and here we're looking at the oil again on the Aussie chart, I should say the US chart, on the daily time frame, and we can see another wave cycle around these levels here. What we'll probably have is a wave 1 around this level here, a wave 2 for the pullback, and then the wave 3 lower. Now the wave 3 is generally what we determine and the easiest to see up front, and we can see that for again, it's after this had this pullback, the next move we can see this first large AO. So it's likely on a lower time frame we would have 1, 2, 3 pullback for wave 4. So if we jump down to an hourly chart, a 4-hourly chart, we can see we've got a move down lower, and it's likely we now are going to be progressing higher. So let's jump back to the daily chart, do the same thing as we did on the German 30. We use our Fibonacci retracement tool, put the highs of wave 3 to the lows of wave 3, and we're expecting a pullback to about 38.2 to 50%. As you can see, looking left, we have support and resistance areas. Here's our Dsr indicators indicating we have some resistance around this level, and it's also around the 50% mark. So definitely if you're looking at getting in, you want to get in around these levels or slightly just below, and you'll be putting your stop losses roughly around 500 pips and going for probably about 10,000. So again, we've got another good risk to reward of risking 1 to make double. We always want to have a higher risk to reward. That way, if we only get it right 40% of the time, we're still going to make that little bit of money, because every time we're losing 100 on those 6 trades, the other 4 trades we make 200. So 6 trades at a loss of a 100 is $600. 4 trades making $200 is $800. Therefore, we make $200 on the trade, and that's with only a 40% success rate. So always remember, risk to reward is the key in trading. So let's just zoom in to the chart and just explain what has happened overnight. And what we had was the Saudi minister announced that there is no way they're going to be stopping the oil production. Now, as a result, the oil is finding weakness. So that was not good news for anybody who believed the oil was going to go higher, and believing they're going to slow productivity or halt it, just as they announced in Russia that they'll likely will stop producing anymore, but likely continue what they're currently doing. Is the opposite news, and they're saying nope, we're going to continue to pump it out, and they may even pump more. So if we believe that's the case, it's definitely going to be doing its wave 5 move lower. But I still feel we've got an A, B, C cycle higher. So I want to see an A, B, pullback for C around these levels before I will get in, because I need that for my risk to reward. So thank you for watching week 8 of the Forex market review. Please go ahead into the training course section and purchase a Dsr indicator if you think it'll work well for you. I wish you all your best and success. Take care.